Well, hi everyone. Welcome to the Buffett and Beyond Research Saturday ETF report. We're going over some stocks in the consumer discretionary, but the health XLV, the health sector, we've gotten some buys by some of the analysts on TV, and gee, I'm just not so sure. But anyway, this is July 26, 2025. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. So here we are at big charts, and the black line is the S&P 500, and we are looking over 1 year. Now, the blue line is the consumer discretionary, and it has been outperforming the S&P 500. And we're going to look at that in a second from the computer program. Now, down here is the XLV, which is the healthcare. And folks, yeah, you can see the healthcare down here doesn't seem to be moving. It dropped down. And remember, this is 1 year, so it started over here and it's down down about 10%, while the market is up about 18%, and the consumer discretionary is up close to 25%. So we are looking at some of those analysts that saying it's time to buy the healthcare index or the ETF, and we're saying, gee, we're just not so sure. And let us look at United Health, because United Health is now being investigated as to some kind of scamming with the payments from the U.S. government and on, or Medicare payments, I guess it is. Who knows? The news just came out, but let's put that in here. So we go all the way over here, and we will put in United Health, and we'll come back here. Now, again, 1 year. Black line is the S&P 500. This is the XLU up here, the consumer discretionary. Here is the health ETF, the XLV, and we're saying it's just not moving lately. But look over here. This is United Health, and that news just came out not that long ago, but boy, oh boy, now we're hearing it's an investigation, and other people knew it before we did, and here it is down 50% for the 1 year. That's a long way to go, folks. So that's what we're looking at now. And so the answer to the question is we're just not so sure that it's time to buy the healthcare stocks. We'll just wait for them to do something. But the one we want to watch is the United Health to see what it does. And being down 50% for the year, actually being down 50% in the past 4 months or so is not too good. And yeah, it looks terrible. And we used to have this stock in our portfolio about 3 or 4 years ago, maybe 5 years ago, and we haven't had it since because it just hasn't been doing anything. As you can follow it back, it's the red line. And yeah, just not doing too well. And let's go to the computer program. Yeah, we have to go to the subscribers locker. This is on BuffettandBeyond.com. Have subscribers locker. Come down here to the ETF and click here, and then come all the way down to the bottom and click here. And where do I want to go? Over to ETFs up here. And we are going to hit consumer discretionary. So the consumer discretionary is doing very well. And let's go from the highest to the lowest. And the first one we're looking at is Amazon. Well, we have that in our other portfolios. Now, Norwegian Cruise Lines, I want to show you something here, and Las Vegas Sands, they both have very high projected ROEs. And as we look back, gee, they look pretty good. But I have to show you a little trick in here. And then we have Airbnb, Decker's Outdoor, Marriott, Chipotle down here, Lululemon down here, which we used to have, Chipotle, which we still have. But you recognize all these stocks, and we have them in other portfolios, so we don't have to go to the consumer discretionary, the XLY, and pick out the best stocks. But really what I wanted to show you in here is you got to be careful of these numbers. So we're going to Norwegian Cruise Lines, and we're going to click on that. Now here we see down here in net income that it had 3 losing years. And yeah, it started in 2020. That was COVID. And so we want to look a little closer at that. So I go into my own computer sheet and want to show you something, that when you see these negatives in here like that, and then all of a sudden it starts coming back up and you start seeing a good clean surplus ROE, you say, gee, maybe that's the stock we want to buy. But you have to be very careful, and I'll show you why. And I'll show you first on Las Vegas Sands, because now we're looking. Let's make that bigger. Yeah, so now we're looking at Las Vegas Sands, and down here it had a pretty good ROE. Very good. In fact, we almost bought it several times, but we know the ins and outs of the gambling because it can be cyclical. So during a recession, people stop gambling. They keep going to the shows and things, but they stop gambling. So look at owner's equity down here. So owner's equity over here was pretty good. Then when you had these 3 losses in a row, and we're going to show Norwegian Cruise Lines also, the same exact story in here, that lowers the owner's equity. It takes away. So these people that owned back in 2019 and before lost a lot of money here. And now the stock is starting to come back, and the net income or clean surplus earnings are going up, and you come over here to clean surplus ROE, and it looks very, very nice. But when you look closer and you see these negatives in here, now look at the owner's equity. So right here, 2023, I'm just taking an example, it was $8 right there, $8. But look at 2016, it was $13, almost double what it is now. So in other words, the owners that had this stock way back then, their owner's equity has been cut in half. And that's why any net income looks better, because the owner's equity is lower. So what has happened to this stock? And let us go to Norwegian Cruise Lines while we're here. Now, this is my own personal Excel spreadsheet, and I do all of this by hand, because if you go all the way to the right, it goes column after column after column. I'll even show you here. It just goes on and on and on and on and on. I have all kinds of sorting that I can do here that I can't do on our program on site, because it just doesn't have the capability to do that. And no matter who we call, do not have the capability to do that. So we're showing you this. And this is how I do my research. I do all sorts of sorting, and see the industry over here. I'll go to all the stocks that are in the hotel gaming and see what they have done. So there's things on here that I can do on my own spreadsheet with about 700 stocks that are updated manually all during the year. So you think I use the computer program and then go to the beach. No, it takes me all year to form these portfolios and then give them to you, and you can go to the beach. But I'll see you there if I'm walking by real quick. But I don't spend time there. I spend time right here. So again, we had people that had a lot of money in this stock and kept putting money back into it. Not your personal money. You bought it once, but the company was making money and building up your wealth, and then all of a sudden it lost almost half of it. And so the numbers look better as you come over here to clean surplus. They were in the negative, and now they're looking good. But once you see this big loss in here, you have to be very, very careful. Is the stock really coming back? Let's go to Norwegian Cruise Lines, and gee, if it doesn't look the same. Do you see what I'm getting at here now? Now, Norwegian Cruise Lines, look at how much the owners owned, and I'm talking about the shareholders. They had a big, big owner's equity, and then Norwegian Cruise Lines lost big time in here. And look how low the owner's equity got. So any money it makes gives us a high clean surplus ROE. So when I don't say, how about Norwegian Cruise Lines or Las Vegas Sands, because it has a high ROE, you have to look further, or that's why you asked me, because I'll tell you, no, let's not get into that. Because of this net income loss, it has reduced the value of the company in here by 4 times. So in other words, it's much worse than Las Vegas Sands, because these are cruise lines. Boy, there's a lot of money in those ships. You know, putting up a gambling casino is nothing compared to building a cruise liner. Believe me, folks, I was in that business, so I know a lot about the engineering end of it. So what you can see is you're fooled by this. So now let's go here. Let me enlarge this. We'll enlarge it. Now we're looking at the S&P 500, and this is over 10 years. Over 10 years. So the black line, the S&P 500, blue lines, Las Vegas Sands, and this yellowish lines is the Norwegian Cruise Lines, or represents the Norwegian Cruise Lines. Look back over here. Yeah, this is 2020. And that's when COVID hit, right in here. You see, when you're on the 10-year schedule, 2025, 24, 23, 22, 21, 2020. And you can see how these companies lost. Blue line again, Las Vegas Sands, and this is Norwegian Cruise Lines. Down here, the yellowish lines. They never regained, even though that ROE is looking very, very high right now in both of these stocks. The market looks at it and says a lot of investors' monies have gone down the drain because of the losses in this year. This year right in here, in 2020, and they have never regained that owner's equity again. Even though the clean surplus ROE looks good, then the people getting in now are looking at the old clean surplus ROE and comparing it to the new clean surplus ROE. And the new clean surplus ROE looks better, but that's a clink in the armor of looking at stocks that lost money. And both of these companies lost money 3 years in a row. 3 years in a row, 20, 21, and 22. And now they're both making money, but the stocks have not gone up, have they? That's because of the low owner's equity. So you're buying companies that are worth a lot less. Now, maybe as time goes on, they'll eventually come back and do something, but why not be in stocks that are doing something right now and doing very, very well indeed, like our portfolios that I'm about to show you in a second here. So let's go over here and let us look at our top stocks, and this is the NASDAQ 100. And as of Friday midday, the QQQs, the NASDAQ 100, the QQQ is the symbol for the NASDAQ 100. It's the ETF, up 10.7%, up about 0.8% since last week. And the S&P 500 is up a little bit more than 1% over that time. And our top portfolios are up about 1% or 0.9%, just like the QQQ since then. But look at this. Top stocks in the QQQs are outperforming the S&P 100 by almost double. That's for this year. Now let's go back to last year. It was up, this portfolio was up, well, with one or two changes, was up 47%, while the S&P was up half that. And the year before, 2023, this portfolio, with a few stock changes in there, but the top stocks up 97%, with the S&P up 1/4 of that. And then over 5 years, it's up, this portfolio, or the top, I should say, the top stocks in the NASDAQ 100, which is the QQQ, the top stocks in that index, up 422%, with the S&P up 82%. So that's a big difference, folks. And these are the portfolios that we don't mind hedging 10, 12, 15% below the present level of the market, because it's a little bit more volatile. But look at the returns you're getting. You're doubling the S&P 500 right now. Not too bad at all, folks. And let us look at the sector all-stars, and going through the same motions here. It's up 11.7%, with the S&P up 8.4%. So it's outperforming again by a long way. It's got more stocks in it than the QQQ top stocks. And so it's a little less volatile, and it's doing very, very well. And again, if we look down here, we're seeing last year was up 36%, with the S&P up 24%. And in 2023, again, up 97.9%, where the QQQs were up 53%. So down for 2023. This portfolio, with the exception of several stocks, was doubling the QQQs and way above the S&P 500, which was up about half that of the QQQs. So our portfolios are doing very, very well this year. And I just wanted to show you the Las Vegas Sands and Norwegian Cruise Lines, because some of you said, hey, they have nice ROEs, clean surplus ROEs, why are they not in our portfolios? And the reason is that their value has been cut in half and more than half, depending on which of those stocks you're looking at. So therefore, investing in it now is maybe a good idea, but not a great idea. not when you have stocks like this that are making a lot of money out there and growing their earnings very, very well and very, very quickly. So those are some of the things that you have to watch out for. So folks, we had another good week this past week. Our portfolios are doing great. They're outperforming the S&P 500. Remember, over any 10-year period, 96% of professional money managers who manage the publicly traded mutual funds cannot outperform the S&P 500. And over the past 22 years, we have outperformed the S&P 500 2.5 times to 1 on a compounded basis. So we're doing very, very well with our portfolios. You go out this weekend, forget about the market because it's going to be here next week. Believe me, you go out, you be safe, be with your family, have fun. And folks, we'll be right back here in a couple of days. So stay safe. We'll see you then.